Good morning, Bitcoiners, and welcome back to this week's economic calendar. The time is finally here. The much-awaited Fed meeting and interest rate decision will happen this week, and markets, as you know, have been quite volatile heading into the decision. Now, although nobody can predict the future, the Fed's goals and where it wants to take the US economy is quite predictable. And in today's issue, we're going to break down what Bitcoin investors can expect from this week's interest rate decision and beyond. It's going to be a great one. Grab your coffees. Fed Week is finally here. The meeting that started today will culminate with tomorrow's press conference where the Fed will announce a new interest rate decision for the next 2 months. Let's remember the next meeting will happen in mid-November. And markets have been quite volatile since last week's CPI report. The inflation numbers came out and it showed that inflation was still running quite hot in the United States. That made investor expectations shift. They were previously expecting a 50 basis points in tomorrow's decision, but now if we look at the CME FedWatch tool, we can see that going into the meeting, there are now 84% of investors that believe we're going to get a 75% basis points hike. Now, it is pretty much a given that the Fed will have to keep raising interest rates to at least 4% and above, and that's from the current 2.5%. And that has investors like Ray Dalio going as far as to say that interest rates need to move to the upper bound of the 4.5% to 6% range. And similarly, he signals that according to his estimates, if the rates were to go to 4.5%, that would imply a further 20% drop in equity markets. Now, while the future is unpredictable, the Fed's stated goals and where it wants to take the US economy is quite transparent and therefore predictable. And despite all of the unpredictability we have in the economy today, if we take the known truths or the known stated goals from the Fed, we can get a pretty good indication or idea of where things might be headed. So let's recap a few of the known things for now. So, known number one, the Fed wants to bring inflation back to within 2 and 3%. That is undebatable. Fact number two, the Fed has indicated that once it settles in its steady state, the interest rate should be slightly above the rate of inflation. And so if we assume that inflation would peak at 3%, then we would assume that interest rates would normalize at the lowest at 3.5%. Known fact number three, we know how the consumer price index is calculated. That formula is transparent. And we also know the data, the pricing data for the trailing 12 months. Therefore, we can do some assumptions and work out when exactly the CPI will be back into normal ranges or how fast it can get to this 2 to 3% range. Now, as you can see from the chart on your screen, based on all of the data that we know, the earliest that inflation readings could get back to within 2 to 3% or under 3% would be in the spring of 2023, as you can see here in the chart that shows some sensitivity. So in a best case scenario and in a good case scenario even, we'd be looking at spring to early summer of 2023 to get inflation readings under 3%, okay? Fact number four is that there is a very strong correlation between the size of the Fed's balance sheet and the value of assets, whether those are stocks or real estate and or Bitcoin. And as you can see from the chart on your screen, the correlation is quite evident. In other words, the Fed sees the stock market and real estate as drivers of the wealth effect. These are essentially things that make people feel wealthy and therefore spend more. And the Fed is using or uses its policies right now to feel people wealthier or poorer to drive economic behavior. So right now it is trying to make people feel less wealthy so that it contains economic activity. Now, fact number five that we know, and this came out earlier this week, is that the Fed is actively trying to keep the wealth effect in check, and hence market prices or the level of indexes like the S&P 500 and NASDAQ in check. This week's Wall Street Journal article is a clear example of this. When the writer Nick Timiraos published this article, he tweeted, Jay Powell ditched his original Jackson Hole speech last month after markets turned excessively optimistic after an inflation turnaround and Fed pivot. The one he delivered was shorter and nuance free. So again, this makes it very, very clear that the Fed is paying attention to how markets react to what it says, and it is being very, very careful to not give markets the wrong idea, as it wants to keep them contained right now. Now, known fact number 6 is the fact that the Fed has openly stated that it is planning to reduce the size of its balance sheet by $95 billion per month. For context, back when it was stimulating the economy, it was buying $80 billion per month in mortgage-backed securities and treasuries. In other words, it is reducing the size of its balance sheet. It is decidedly going down, and this should continue to put pressure on markets. Now, with all of these knowns, what conclusions can we draw from this? Now, after recapping all that is known, what takeaways can be drawn from this information? Well, takeaway number 1 is that the Fed does not want asset prices or markets to rally or rise until inflation is back to within 2 to 3%. It is doing this to keep the wealth effect in check, as it does not want people to feel wealthy and go out and spend more money. That is takeaway number 1, and they're very clear about this. Takeaway number 2 is that the Fed has openly stated that it's trying to, or in the act of, reducing the size of its balance sheet to the tune of $95 billion per month. Given the tight correlation between the S&P 500 and the size of the Fed's balance sheet, which we covered in the graph above, this means that asset prices and the S&P 500 should remain under pressure until then, which again is consistent with point 1, keeping the wealth effect in check. Now, what does this translate to for investors? Investors should expect at least a 75 basis points hike or announcement in tomorrow's meeting, and most likely a sobering speech from the Fed. At best, it may suggest that future interest rate hikes will be data dependent, but Powell will not want to risk coming off too friendly to prevent a knee-jerk positive reaction or rally in markets. As we saw, they didn't like that from last meeting. Now, with all this being said, markets seem to have recalibrated their expectations for interest rate hikes after the last week's CPI number came out, meaning that the market could hold up well after a 75 basis points announcement, because it seems to be very much priced in going into this event. Now, again, a couple of things to keep in mind. The earliest that we can get back to 2 to 3% inflation in the US, assuming a happy path, as per the chart above, is between March and July of next year. The other thing that we also know is that the stock market and other assets work with forward-looking expectations. So again, what can investors translate from this is that many investors are keeping a close eye on key market levels as we head into the fourth quarter of this year, because many investors are expecting that the worst in terms of asset pricing should materialize sometime in the coming months, which could provide some interesting buying opportunities into the first quarter of 2023, where things should be coming back into control. So again, although the future is very hard to predict, the goals of the Federal Reserve and where it needs to take the US economy are not so hard to predict. And we know from the data above and the tools at the Fed's disposal that in the current market conditions, investors like getting paid to wait. And in these environments, savings accounts products like the ones we offer at Ledden let you earn up to 7.5% APY on your US dollar tokens and up to 5.25% on your first 0.1 Bitcoin. This allows you to have the assets earning interest, and you can essentially trade between those assets at any time. Now, with the Fed wanting to keep equity markets and asset prices in check until at least the end of the year, it effectively is providing an artificial upper bound or upper cap on asset prices. Now, with that as our base case, the two remaining outcomes are a sideways progression until the end of the year, or potentially further downside before a recovery. And in this section, we're going to break down what could effectively derail us from the sideways chop for a few months and bring us into further downside. And these are just a few things to watch out for if you're an investor and active in the markets. So the first thing to watch out for would be a breakdown in the US real estate market. Now, from the chart on your screen, you can see there's a very simple reason to be worried about the US real estate market. And that is that lending to the US government is yielding close to the same amount as owning and renting a house, with all the pains and risks associated with buying and renting a house. And this is a clear tell sign that the real estate market is about to come under pressure, if nothing else, by selling pressure from real estate investors and not end users, who are basically weighing the potential risk reward of owning and renting real estate properties versus the risk reward of lending to the US government. Now, raising mortgage rates may also drive several participants to repay their personal lines of credits and mortgages, draining money from the economy that would have otherwise been spent elsewhere. The other watch out for a potential, that could derail the economy would be a potential spike or a renewed spike in energy prices. A big driver of lower inflation, of the recent lower inflation that we are seeing, is the astronomical drop in the price of oil and therefore gasoline. The interesting thing is that this price drop was not natural. It was pretty manufactured. It was done by draining the strategic oil reserves from many countries, with the US being one of them. As you can see here, it is a 40-year low, the status of the US oil reserves. And to add to the concern, we are starting to see capacity headlines. The US private oil drillers are hitting their limits. And we also saw that there is chats around production capacity with OPEC. So again, if energy prices start rising once again, inflation will remain sticky for longer, meaning that the high rates could remain there for longer because it's going to take a lot more time to bring us down to 2 to 3% inflation. Therefore, that upper cap could stay in play for a bit longer. And as always, we wrap up the show with what you can expect for the rest of the week and when you can expect that data. This week, we got interest rate decisions from the US Federal Reserve, the Bank of Japan, the Bank of England, and the Swiss National Bank, among others. And before we get there on the details, we wanted to briefly check in on the Bitcoin and Ethereum relationship since the merge, which went down smoothly last week. Now, as we mentioned, the merge went pretty smoothly last week. And once again, the old buy the rumor, sell the news saying that is very famous on Wall Street proved to be true this time around. The price relationship between Bitcoin and Ethereum is once again in the mid-range of its historical levels. This again is checking in on the chart that we shared last week. The reversion to the mean into the merge played out quite favorably for Bitcoin, as we can see so far. In Bitcoin terms, Ethereum dropped 10% since our report last week. And this shows that although people were excited by the merge, the event was unable to draw in net new buyers for Ethereum at the current price level. Now, we're going to keep an eye on this to see if economic activity or developer activity continues to consolidate in Ethereum, which could drive up this relationship and drive interest to test the upper bound of this relationship between Bitcoin and Ethereum once again. Now, here's what you can expect for the week ahead. Tomorrow on Wednesday at 12 p.m. Eastern, we got the Federal Reserve decision on interest rates. That will happen at 12:30, Jerome Powell a press conference. Tomorrow at 9 a.m., we get the Bank of Japan interest rate decision. And on Friday, we get interest rate decisions from the Swiss National Bank and the Bank of England. With that, we've reached the end of the show. If you learned something, if you liked it and you laughed, I welcome you to subscribe. Thumbs up, like it, and share it with your friends. If you don't yet have a Ledn account and you want to get paid a great interest rate while you wait, you can check us out at ledn.io and see how you can earn up to 7.5% on your USDC and up to 5.25% on your first 0.1 Bitcoin. We also have the best rates for loans if you need liquidity but don't want to sell your Bitcoin. And our most recent product, the Bitcoin Mortgage, lets you buy a house as big as your stack. Thank you, everybody. Have a wonderful week. Y los quiero mucho.